Morning traders, Paul here with GammaEdge. Today is June 15th, Wednesday, FOMC. Let's get started. Please pause your viewer, read this. It's important to you, it's important to us. The market model, no surprises here, remains bearish. The 52-week new high, new low breadth is extremely poor. When you look at the ratio of the new lows to the new highs, you can see just how bad that breadth is. We watch this. It's a lagging indicator, but it's a confirmation indicator. You want to probably pay attention to this. The filtered cumulative tick, which is filtered at 1,000 ticks per minute and above, sold off periodically throughout the day, not as rapidly as what we saw the previous day on Monday, but nevertheless, net negative for the day, risk off, a lot of downward movement as we all experienced. The trend lines are still down, negative slopes, long term, we're still in a bearish stance. Shorter term, we've got quite a bit of range here. We are deep below what we call the ribbon or the historical moving averages. We do believe that we should be selling the bounces, and so we will be positioning accordingly on any rips. The index conditions, overall, we're seeing some net negative gamma being added. Even though yesterday, there's a 0 DTE every day now on the SPX, we did see an increase in this net negative gamma compared to the previous day. That is important. I will note that the zeros of the complex for both the SPX and the SPY did slightly fall compared to the previous. That means there has been an addition of puts and a subtraction of calls in the short-term sense across both of these. The Qs paint a different story. Although we did have a slight decrease in the zero, we actually had a movement from 280 to 270 in the put gamma exposure. That's important because that indicates that some of the puts have been monetized or calls have been added, and we think that that's fairly important. Same thing here on the open interest. You can see that it dropped from 350 closer to price now at 300, which means traders are positioning for a potential move up in the Qs, and we want to pay attention to that. IWM, same story, virtually unchanged. Really, really hard to discern here. Volatility, we did see some of the call structure drop, which is indicative of a potential move up. We don't know that for sure, of course. Taking a look at yesterday was the monthly expiry, so we have to go out for the next week, and the presentation has changed a lot. You can see there's still a lot of positioning up here with the 35 calls. The dot is where we are right now. So looking out over the next week, we've got this expiry structure for next week and want to pay attention to that. All of this will be coming off. So we're looking to see, as a net change, we're looking to see some of this, what we call the net negative gamma, come up, which means puts would be added to the overall VIX, indicating that there was anticipation that the markets would advance. Taking a look at the gamma history, what we're showing here is real time for today. When I took the snapshot here this morning, and you can see that we're remaining elevated, slightly below yesterday's level. So the Euro session overnight is still hanging in there. We're at this 35 level here for plus GEX. We don't think VIX behaves in the gamma sense, but we do like to present the data in the same way because it helps us have the continuity of what we're seeing. Near-term expiries, I've highlighted where we are. The black dot is where we are, and then the various levels that you can see here. Note that we're starting to encroach again back up on the local zeros within the expiries. As the numbers here get fairly large, you can see that the net cumulative expiry is fairly significant. This does open up the possibility, especially on the Monday, Wednesday, Friday, for the equity settled ETFs like SPY, Qs, and IWM, that they could get monetized and push up. I will mitigate this a little bit by saying we're very close to the zeros, and the closer we get to the zeros, the less the dealer action has to be. So we're above this 360 in the SPY. That's where the predominant level of being in the money versus out of the money would be. So moneyness decreases on the put side as we increase in price. Not a lot of pressure in here to move aggressively up. Qs, same thing, 270, 279 is the zero. We're very, very close to that. Low pressure area, IWM, moving up towards the zero. Extremely low pressure area, not seeing anything. Here you can see a lot of call gamma coming off, and we're below that, so that's out of the money. So very, very low pressure on the expiries. Not expecting a lot of action there, but just be aware of it. You should watch it. The SPX structure, posted this on Twitter a little bit ago, a couple hours ago. We do think that we've had a significant drop in the overall zeros of the complex. That's significant in that calls have been closed, puts have been opened, and that pulls the entire complex down. This is a price invariant model that we have. It's important because it's based on the overall structure of the VIX. Of the SPX. The JPM levels are shown here. We've got a lot of gamma levels in here, which is going to provide some overhead resistance. Down here below, we've got 3620. We've got a significant amount, 44,100 at the JPM short put leg. What happens there is explained here, but as we drop in price, this will become a counterbalance to the overall system and should provide some headwinds to dropping further. So make sure you understand this. Very, very important. We do think we're range bound between this lower level of 3600, 3620 area up here to the 4000 level, and we think getting across 3900 is going to be pretty difficult. The 0 DTE, a lot of little hiding places have emerged in the 0 DTE. You can see in the back and forth between the red and the green on the gamma side. We have seen, especially with these large transitions, these become hiding areas into the end of the day. They're perfect for setting up a low-cost fly. If you can get a fly for a 5-cent debit, that wouldn't be a bad play in several different areas and just see where it goes. Paper trading, of course. I've got some verbiage over here you should read. The key takeaway here, fairly significant expiry. Expected move is still very, very high. Look at the net delta dollar notional expiry for today. It's going to be hard to push up into this area, but if we do push up into this area, I don't think we're going above 3,900. Even 3,850 would be a stretch. That would be the last hiding place into the close. And note this is the dominance call open interest expiry for today. The combo, which is the AM and the PM settled, this is the mothership. This thing is what is rolling off. Last trading day will be Thursday, expires at the open on Friday morning. Extremely large negative number here. You can see where COI, the call open interest, put open interest is here. They are offsetting with a slight bias to the negative gamma side. Extremely large net delta. Notional up here at 4,000. Almost impossible to get through that in a very, very short term. This would have to be offset by a tremendous amount of calls, and frankly, although we are seeing calls go into the complex, they're not going in at the rate. This number, incidentally, has only fallen by about $4 billion in overnight, which is not enough really to compensate. I've highlighted each of the yellow areas. Make sure you take a look at those. You can see where we are. This is where we closed yesterday. 3,800, a big level to get through, big gamma level to get through. 3,900, same thing, big delta notional to get through, gamma level. It's going to be hard to push up in this area, especially with the structure that I showed on the other slide. 3,700 to the downside probably is still the line in the sand. You can see where we are in terms of puts and calls here. Over here, note that the numbers have reduced slightly. We're at a little over 40% yesterday. We're now at about 37%, 36 indicated with some slices that aren't labeled here. This is a big deal. The fact that these have dropped and the price is still down here in this very low area means that we're starting to see a shift outward off this expiry, and that's important. The expiration, huge drop in this. So I want everyone to think through what happens as the overall as this starts rolling off, what happens to the change in delta and what the dealer response has to be to that. The SPX structure, final slide before we get to the conclusions. I will note that the magnitudes are going up even though we are way down here. This is indicative of a call structure building out. That is good. This is a different presentation than what we had yesterday. I would urge everyone to go back to yesterday's morning call and take a look at the differences here. The JPM level has reemerged at 42.85. These are long puts. They are Delta 1 right now. So that's a big deal. You can see effectively where we are, the line in the sand, 3,600. I don't think we're going down that area for the reasons I've already talked about, with that 3,620 sitting there with that short hedge there. Just be aware though that we've got a lot to dig out of, and it's going to take some time to get there. So the summary for today: market model's bearish. We still believe to sell the bounces using your paper money, of course. Liquidity below 3,700 remains very scarce. I didn't go into it in great detail today, but the quarter levels seem to be the primary levels to look at. The monthly OPEX gamma is dropping, which is good, which indicates that the roll has started, and where that money goes is a big deal. The JPM short leg at 3620 we think is a headwind as we drop, and we think that will stabilize movement. If you don't understand that, come on into the Discord and ask some questions. We're happy to talk more about that. Market model, again, inverted and downward. Short term, breath is poor, as I said, and downward railroad tracks, and we think that you sell the rips. We could get a short-term rally here, but we don't think it's going to be lasting, at least not with the data we have right now. The ring charts are bearish. The Qs look like they're improved. Multi-day upside target really puts the resistance ceiling at 4,000. We don't think that's going to happen. We don't think we're going to lose 3,700. And if we do lose 3,700, we don't think any lower than 3,620 is possible, just because of the JPM pin there. That'll go away at the end of the quarter, by the way, end of the month, end of the quarter. So we do think the range for the end of month, end of quarter is this 3,620, 4,000 right now. We just given some of the data and where we see some of the neutral positions, we think that 3850, plus or minus 100 points or so is probably where we're going to end up. So that's it for today. If you like today's content, please join us here at GammaEdge.us. That'll take you to a sign-up page, web page. That'll get you into the Discord, 14-day free trial, all the tools turned on, a lot of commentary going on, a lot of folks active in voice. Been growing, voice channels been growing day over day over day. I think we average about 20-25 people in voice at any one time. Follow us on Twitter, please, at GammaEdges with an S. And then here on YouTube, smash that like button if you like today's content, and then subscribe, of course, so you get notified next time that we post content. So that's it for today. Hope to see everybody in the Discord. Good luck, FOMC. Don't get out over your skis, and we'll see you later. Take care.